Well, the U.S. GDP grew at a slower than expected pace in the first quarter of this year. It increased at a 1.6% annualized rate compared to 3.4% in the fourth quarter of 2023. What does it all mean? CBS News business analyst Jill Schlesinger is here with me in Studio 57 to break it down. I don't know what those numbers mean. What do those numbers mean to the average American?
Let's talk about what the letters mean, gross domestic product. So it's basically the tally of all goods and services sold. That's it. So that's why it's seen as a big report card, the biggest way that we look at economic growth and conversely, contraction. Okay, so we grew, but we were expecting stronger growth. As you said, lower than expected. Last year, we kind of shocked ourselves because everyone was thinking we were going to have a recession in 2023. Didn't happen. Instead, the economy grew by 2.5%. And so when economists looked at the first quarter of this year, I think they looked at the jobs report, they looked at some spending reports, and they predicted we'd have a 2.5% annualized pace. As you said, it's 1.6%. So what happened? So things are slowing down a little bit. Weirdly, it's exactly what the Federal Reserve wants.
That's what I was thinking. This is actually good news because all the other stories are we won't stop spending, so we can't get a handle on inflation. So then, of course, the only thing that matters to most regular folks is what does the Fed think? What does this have to do with interest rates?
Yeah, I mean, I think there's a couple of things to note. First of all, this is the first reading of growth. So every time we get our quarterly report card on the economy, we get 3 actual results. So this could move up or down. OK, now, I don't think it's going to go to 3%, but it wouldn't be shocking if all of a sudden when they tallied it up the second and third time we're at 2 or 2.25%. That wouldn't shock me. And it wouldn't shock me if we're at 1.3%. So the Fed's going to wait for the data. I think the Fed is still in a moment where they're saying, let's chill.
Right.
Why are we going to chill? Why should we do anything? Next week is a meeting. And I think that to move next week would be very odd. We know that prices, the inflation rate, still remains above where the Fed wants it to be.
All right.
And you know what? The job market so far has been pretty solid. Fed's got to do this balancing act. We want to make sure the economy cools down, but not so much that we snuff out this nice labor market. So I think they do nothing next week. And I do think that if you look ahead, if we start to see week after week, month after month, in the next, say, 6 weeks or so, before the following Fed meeting, if we see things really start to decelerate, that first rate cut of this cycle is back on the table for June. I think most economists said, well, no way, we're going to wait till after the summer. But if things do slow down, the Fed officials themselves have said we're data dependent. So if things slow down, they think they can cut, they will. If not, not.
All right. Sounds good. Well, I like that. This is a good news story to me, as long as they don't go up. Jill, thank you very much.
Pleasure.